Let's go now to our guest, Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
What is happening? Because we are recording this a day earlier than we normally do, so it's Tuesday the 17th. Tuesday the 18th. So it hasn't been that long since we talked last Wednesday, but some data came in. I mean, where did we stand? I saw a headline that said a big bank was maintaining their 2 cuts before the end of the year outlook, despite hawkish language last week from the FOMC stuff. Where do we stand in your mind?
I think that the Fed is going to be more inclined to cut this year than was stated during FOMC and versus what they had in the dot plot. I think you've seen CPI data turn lower and key components in CPI move lower. Like housing came in at 0.3, PPI was soft, and if you extrapolate the components of CPI and PPI, you're looking at a PCE print next week that is going to be anywhere from like 0.15 to 0.2. The Cleveland Nowcast, has it at 0.21 month on month. And so, you're looking at an annualized PCE number that's going to be close to like your 2.6 area, which is right on target, which is what the Fed wants. In addition, you've seen softening in employment indicators. You've seen, although non-farm payrolls is the small exception to that. And then you've also seen retail sales miss to the downside today and over the past couple of releases. In addition to that, you had revisions lower to retail sales of the prior month today. So it looks like spending is coming in soft. You've got inflation indicators that are moving more towards target, and you've got employment kind of softening as well, and that means that the Fed is definitely headed in the right direction and could certainly be warranted in cuts. Taking it a step further, I think that the data is going to continue to deteriorate over the next couple of months. We're going to see probably a bigger uptick in unemployment as a function of some revisions, and you're probably going to see continued slowing in broader economic trends as well. And then you're going to start to be in a situation whereby the September FOMC or even the July FOMC, where it really makes sense to start cutting. Because if you think inflation is moving to target and you're confident that it's moving to target, then you are probably 200 basis points too high in terms of where rates are currently set, right? Neutral is probably somewhere close to 3%. And right now the Fed funds range is 525 to 550. And so that means you could, in theory, be very far away from neutral. So I really think that you're on the cusp of a very significant kind of light switch going off in the market, that being that data's turned enough to warrant cutting, right? And if logically you're at the point where you're like, I'm comfortable cutting, then you should really be thinking about the magnitude of your cut and how quickly you should be doing your cuts to get to neutral, right? And so I really think you're on the cusp of the market starting to think about cuts in the 50 BIP increment, back-to-back 50s even.
Wow.
Because realistically, if unemployment really is coming lower, I mean, I've got a guy telling me that the payroll revisions coming out in August are going to take unemployment close to 4.3. The summary of economic projections that were released for June during last FOMC had unemployment going to 4%, right? And so I think we're at 3.9 now. And so
That's
if
a
you could,
pretty big jump.
You could be at like 4.2, 4.3 pretty quickly.
Yeah.
And then you're going to tell me that peak core PCE is at 2.6%, which is, let's just say that's pretty good.
Yeah.
And so quickly the market could be at a point where they're like, wow, employment's softening, inflation is softening, everything seems to be turning lower. So why are we at 5% and change?
And now this is the soft landing attempt, right? Because
Correct.
The other argument would be that the risk of reinflation is so high that like it can still bear more.
Yes.
But the danger from that is that you end up having the economy have a pretty hard landing.
Correct.
Because once you start accelerating from 3.9, you're saying to 4.3, that's a pretty big jump if that were to happen.
No, absolutely.
All of a sudden it's like, holy crap, like unemployment picture's looking a lot worse. Better if you want to cut, worse if you
but
need
there's
a job.
so many things that already are signaling. Like, part-time employment this year is up 18%.
Well, isn't that a big...
You
look into these numbers. Isn't that a big part of the unemployment picture when we say that, when The
Yes,
president,
it
for
is.
example, takes credit for having unemployment come down so much in a lot of those jobs like DoorDash and stuff like that.
No, absolutely.
Like, more than ever before.
And there are like estimates about, sole proprietorships, how many jobs that those things at. And so there's lots of weird anomalies.
Yeah.
And Powell is openly talking about it.
Yeah.
And so, and that's why they pay attention to things like the revisions.
So is there we've talked before on this podcast about, for example, Trump politically, or the White House generally politically, either trying to influence the Fed or not influence the Fed, or the Fed's role in that sort of political situation. Like, wouldn't big cuts, or like any cuts even right before the election? I mean, isn't there some risk? I think you might have said before that theoretically you'd prefer not to do that if you're trying to not to appear to be apolitical. Doesn't that have a big impact, you think? I mean, one way or another?
I mean, at the end of the day,
mean,
there's
maybe
a ton of people that vote with their wallets. They don't care if the politicians are giving them the money or it's a private corporation. And so, I think there's a lot of voters that are like, I'm happy with where my wallet is and what policies are. And so I might vote that way.
Because if they cut rates, it gets easier to buy homes cheaper, and possibly your assets go up. So
possibly,
maybe
yeah.
maybe. I mean, maybe
it's
well,
totally,
probably in
it's
the long
totally
run,
possible.
yeah.
But what I would say though is I would pay attention to the measures that are currently being talked about by the administration. They're super stimulative, right? They're talking about like more relief for first-time home buyers or first-generation home buyers. I think there was a program announced the other day that gives you like $25K back, which is tantamount to like closing costs on the average home these days.
Yeah.
There are more measures to enhance Social Security in terms of eligibility. Folks that are on like SNAP benefits, they might now become eligible to receive some Social Security benefits. There's chatter about home equity loans and what the Fannie and Freddie can do to help assist in that. And so what you're basically seeing from the Democratic administration is all hands effort to stimulate the economy going into the election.
So fair. So is part of your point that a 25-bit cut or even a 50-bit cut, they're already doing plenty on the election side of it, regardless. So it's not like
and asset prices are at the dead highs. Look at the stock market.
I know.
I mean,
do they just go? Let's say we go on a cutting cycle. They just keep going higher.
They're good. I mean, I heard it best the other day. Some guy was like, "So people are telling me that bad news is good news for stocks," and then when there's good news, people are telling me there's good news is good news for stocks. And this week I heard that no news is also good for stocks. So we're just stuck in the point where
I guess
it looks like it's one of the best hedges in the world. And
if you look at it, it is a great hedge, right? I mean, a classic inflation hedge is equities, right?
Yeah.
And they earn cash. But also if you look at the multi-decade history of the U.S. stock market,
well
it is
every
up
year.
only. Not on.
And it doesn't matter what administration's in office. Administrative agnostic.
Yeah. Well, this is a little bit more existential just for the last minute or two here, but is it really up? Have you seen that adjusted for inflation chart where the peak was 1929 in the U.S. stock market?
Yeah.
If we adjust for M2 or whichever metric we need,
you want,
it's actually on a real basis, kind of flat.
The big popular one among crypto folks is relative to the balance sheet.
Yeah.
And so, you could think about it.
Maybe that's why it's up, because the dollar is
weakening, and this is just another expression of that.
It's maybe one way to at least tread water.
Yes.
The other thing is, isn't it mostly just we don't like to name single name equities, but isn't it mostly just one stock that's basically leading? It's or a handful.
It's like 4 or 5.
Yeah.
And the Magnificent Seven is what they're known.
And,
And the big part about them that's very unique from any other point in history is the magnitude of the stock buybacks programs that they have. They are literally constantly on the bid for their own shares. Every day that passes that those programs are active is less supply less float in those companies, and there's a constant bid. And then you have the performance issue where folks are benchmarked to these indexes, and these indexes just keep outperforming most of these folks, and so they're forced to chase. And you're gonna have another Santa Claus rally going into the election, and if you're not long these big names, you're short, and so it becomes one of those things where you just have to keep up. And it becomes, very
self-fulfilling.
Exactly.
I mean, even I didn't want to buy some of these big AI stocks.
And now you're
3 months ago, I thought I was super late, and I was.
No,
and
we could talk about the AI.
They call it the AI rally.
Yeah. No, but Nick Carter.
By the way, it's not just that one stock. It's
multiple,
several of those stocks all have big AI components. And
no, absolutely. And honestly, I think that the AI theme is here to last for decades to come.
Yeah.
It's got implications on everything from power to productivity.
That's what Nick was saying on the pod,
Yeah,
yeah.
and he's actually he was tweeting some good essays out this weekend.
Yep.
One of which I read. But what startled me was really like how folks are dramatically underestimating the power demand growth that we're going to see over the next decade. I heard a couple months ago, I was hearing figures that were like 10% increase in power production is needed, and the paper I read is like that's you need at least 20% plus.
Wow. Well, it's gonna be a big deal. The amount of electricity. This was just crazy. We need nuclear. I'm coming back on the nuclear train, but we'll save that for another conversation. Beimnet Abebe from Galaxy Trading, my friend. Thank you so much.
Thanks for having me.